If you're planning to open a company in Dubai's financial center, choosing the right DIFC license is one of the first big steps. Many people think it's just a formality, but it is not. The license you choose decides what your company can do, how it is regulated, and how banks and partners will view you and your company. So, in this video, I'll explain the different DIFC license types. It includes regulated, non regulated, and retail, and help you understand which one might suit your business or investment structure the best. Before we start, my name is Shiraz Baid, and I'm the founder at Lepidus Wealth, where we help clients and families protect their assets using a range of tools, including trust, foundations, wills, and offshore structures. So, if you own a business or real estate, don't wait until a legal or health crisis to start thinking about protecting what you have built. Instead, request your free and customized asset protection plan by clicking the link below. You can then implement it step by step as your journey progresses. Let's start with the broad structure. DIFC offers three main licenses type: regulated, non regulated, and retail. Within each of these are subcategories that apply to everything from investment firms to family offices to holding companies. Each has a specific purpose and each comes with its own set of requirements, oversight level, and ongoing obligations. If your business involves financial activities like asset management, fund advisory, insurance brokering, or operating as wealth manager, you will likely need regulated license. These are issued under the supervision of the DFSA. That's the Dubai Financial Services Authority. Think of this as a local equivalent to the FCA in the UK or the SEC in the US. Getting a DFSA license is a serious undertaking. It requires detailed business plans, compliance officers, directors, and ongoing reporting obligations. But it also unlocks global credibility. Investors and counterparties worldwide tend to place a higher degree of trust in DFSA regulated entities because of the framework that they operate under. Now, if you are not providing financial services but still want to benefit from being inside the DIFC's ecosystem, a non regulated license may be the right choice for you. These are far more streamlined and in terms of the requirements, and they are commonly used for holding companies, proprietary investment vehicles, single family offices, and certain types of consultancy services. One common use case we see is when clients set up a DIFC entity to hold shares in operating companies or investments across multiple jurisdictions. This provides a tax neutral, common law base in a stable financial center with none of the reputational issues of offshore jurisdictions. It's worth mentioning here that non regulated licenses are issued by the DIFC Registrar of Companies, not the DFSA. So while you don't have financial oversight in the strict regulatory sense, you still need to comply with the DIFC company law, file annual returns, and maintain proper governance. You also have the ability to appoint corporate directors and set up tailor-made shareholder structures, which makes this license type ideal for succession or family wealth planning. Then there's the retail category, which is quite different from the first two. These licenses are used by businesses that serve clients physically within the DIFC free zone, such as restaurants, fitness centers, luxury good retailers, or co-working spaces. If you're not planning to operate a walk-in premise or hire DIFC-based staff for retail purposes, this category is not relevant. But it is important to understand the distinction because retail licenses comes with higher rent costs, fit-out approvals, and DIFC community rules. So how do you decide which license suits your purpose? The first question to ask is, will the entity be providing financial services to third parties? If the answer is yes, then you're looking at a regulated license. And you will need to go through the DFSA's approval process. And if the answer is no, then you move to the next layer of decision making. For many private clients and international entrepreneurs, the non-regulated license is a sweet spot. It offers a strong legal framework, international bank accounts access, and reputational benefits without the red tape of the financial regulation. This is particularly true for those using DIFC entities as part of larger structuring plan. For example, holding companies above subsidiaries in Europe, Africa, or Middle East. One very common question we get is that can I hold personal assets like real estate, private equity, or luxury goods inside a DIFC company? And the answer is yes, but only if the activity falls under the non regulated umbrella. For example, if you're using the company to hold a real estate SPV or stake in private businesses, that will be allowed. But if you start managing money for others or pooling capital from investors, that crosses into regulatory territory. Another thing to consider is the time and cost difference between license types. Regulated licenses take much longer to set up. You're looking at 3 to 6 months depending on the complexity and the DFSA review process. There are also capital requirements, meaning that you need to show that the company has a certain amount of capital on hand based on its risk profile. In contrast, non regulated entities can usually be set up in 3 to 4 weeks and with lower cost base and the lower capital requirement. You should also think about the long term maintenance. A DFSA regulated company will need ongoing compliance reviews, internal audits, and reporting. That means more professional service fee and staff commitment. For many family offices or private investment vehicle, this doesn't make sense. But for someone launching a boutique asset management firm or setting up a VC fund, it's not just worth it, it is essential. Let's look at a few examples. Suppose you are an Australian entrepreneur with multiple operating companies across the GCC and the Southeast Asia. You want a clean, tax neutral holding structure with legal continuity and access to strong banks. In that case, a non regulated DIFC company is likely the right fit. Now, let's say you're launching a fund to invest in early stage tech companies and you want to onboard limited partners from Europe. That requires a regulated license. Or imagine a South African family setting up a multi generational structure to hold their global assets and implement a succession plan. Depending on the level of complexity, a non regulated license combined with a DIFC foundation might be ideal. The key takeaway is that DIFC license type you choose isn't just a tick box. It shapes your legal obligations, how much flexibility you have, what your setup timelines look like, and even how easy it is to work with banks. That's why it's critical to get the structure right from day one. If you are unsure or your case involves cross border elements, regulated assets, or family planning, you need to get advice before moving forward. As I mentioned earlier, if you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.